The accounting practice has its own set of terminology which is known as alternative terminology. It is important you identify each term and its meaning to fully understand and be able to practice accounting. Accounting in the business world refers to the information system that identifies, records, and communicates the economic events of an organization. Liabilities are the debts and obligations of a business. They represent the amounts owed to creditors. Some key phrases that will help identify a liability can be, to be paid on account or paid with a credit card. Assets are resources owned by a business. Examples of assets can be cash, furniture, or supplies. Another type of account is a stockholder's equity account, also known as owner's equity. These accounts for the owner's claim on total assets towards a business. These three mentioned accounts form what is known as the accounting equation: assets equal liabilities plus stockholders' equity. This formula is the base of accounting for transactions. Dividends are payments made to stockholders or those who have purchased shares of stock from a corporation. These are paid to stockholders once the company has enough cash to cover the claims to liabilities beforehand. Till then, stockholders have no claim to corporate cash. Revenue is also a type of account. It accounts for the increase in assets that result from the sale of a product or service in the normal course of business. An example of this can be services rendered in exchange for cash. Cash increases, and one provides a service. The last of the 5 types of main accounts is the expense account. Expenses are the costs of assets consumed or services used in the process of generating revenues. An example of an expense can be rent expense, or income tax expense. Net income is a comparison between revenue and expenses. It is the amount by which revenues exceed expenses. It determines if a profit has been made. If expenses exceed revenues, profit has not been made and it is called a net loss. With the use of the recorded assets, liabilities, and stockholders' equity, a balance sheet can be completed. A balance sheet is a financial statement that reports the assets and claims to those assets at a specific point in time. On the other hand, with the use of the revenues and expenses, an income statement can be completed. An income statement is also a financial statement, however it is used to report the revenues and expenses and resulting whether it may be net income or net loss at a specific point in time. A statement of retained earnings records the changes from one accounting period to the other in terms of retained earnings amounts. Another financial statement is the statement of cash flows. It provides financial information about the cash receipts and cash payments of a business. GAAP or GAAP are the generally accepted accounting principles, which are seen as a set of rules or practices that the accounting profession recognizes as a general guide for financial reporting purposes. Liquidity ratios are a measure of short-term ability of a company to pay its obligations and meet unexpected needs for cash. It can be calculated by dividing current assets by current liabilities. The cost principle states that companies should record assets at their cost. According to this principle, market value should not be taken in consideration. Solvency is the ability of a company to pay interest as it comes due and to repay the balance of debt at its time of maturity. An accounting transaction is an event that requires recording in the financial statements because assets, liabilities, stockholders' equity, revenues, and expenses are affected. A T account is the basic form of an account, where one posts the debits on the right side and the credits on the left side. Each transaction always affects 2 accounts, which is why in accounting the double entry system is used, where the dual effect of each transaction is recorded in the appropriate accounts. It is an elaboration to the T accounts. Source documents are evidence of the occurrence of a transaction, such as a sales slip or cash register tape. The journal is the beginning of putting accounting into practice. It is the accounting record in which transactions are initially recorded in chronological order. The ledger, a group that contains all asset, liability, stockholders' equity, revenue, and expense accounts. The trial balance is a list of accounts and their balances at a given time.